Hey everyone, it's Nick with Us vs. Herd. Today I'm going to be going over the risks of trading options on Robinhood. I'll also give you a quick overlook on Thinkorswim platform just so you can compare what the options chain looks like on there. But for right now, I'm going to be doing this mainly to answer some questions from some previous videos that I did. I'm just going to combine it into here because I don't think people understand the risks of trading options, not only on Robinhood, but just options in general. But a lot of Robinhood users are not used to options mainly because they only had access to stocks before and just got familiar with stocks. And Robinhood really was to get millennials used to trading stocks or investing, and then they started incorporating some other products. Like soon they'll have crypto. I think it's available in a couple states right now, but not available to most. And right now they're rolling out options to everybody. And before options, I would say that they didn't have a way to short the market. And thankfully, with options now, you can short the market. And I know those people are going to say, "Hey, well, you could trade the bear ETFs and stuff like that," but it's not. It's not the same. It's not the same product. Today, I'm going to be using SPY. If you're not familiar with SPY, it's the ETF for the S&P. It tracks the S&P 500, and it's one of the most traded in terms of options. It's one of the most traded ETFs out there. So in terms of options, this is a good example. I traded a lot just because of liquidity. It's easy to get into trades, easy to get out of trades. You don't lose whole lot of money when it comes to liquidity. But I just want to give you a couple of examples here. One thing that I do want to go over is that I made this little checklist here to go over, but options expire worthless. So options are a contract. So let's go to the options chain here. And this is Robinhood's options chain. So options expire worthless. You need to get the timing right. And what I mean by that is here at the top here, there's all these dates for which the contract expires. And now you need your assumption or your contract strike to be where you estimate to be when you purchase it. So for example, let's look at this 268 call here on SPY. Right now the share price is 267.57, so right now we're out of the money by about 43 cents. To break even, it's got to go up a little bit less than 0.5%. It needs to go to 268.81 to break even. It cost me 81 cents, and it needs to be there by April 18th, 2018. So this is in 2 days. So this expired. Today's Monday. So this is a Wednesday expiration. SPY, if you don't know, it expires Monday, Wednesday, and Friday. Most options just expire Friday, but since SPY was so liquid, they said, "Hey, let's make some more money." We'll now have Wednesday expiration, Monday, Wednesday, Friday expiration. So they expire 3 times a week instead of just 1 time a week. But basically, options expire worthless. So if I purchase this here for 81 cents, it's going to cost me $81. I need to be above 268.81, to break even. I don't necessarily think that is true in terms of the break even price, because this break even price is not putting into account for implied volatility. It's not accounting for. So let's say for instance, if I bought this and it went up to let's say it's 267.54 and it went up to 268 within the next 20-30 minutes, this would definitely be more than 81 cents because not enough time went by to wear down the option. So I wouldn't get too stuck on this break even price or percentage to break even. This would be, the break even price would be, it pretty much is 100 shares plus this 81 cents here. So you would need to be 268 plus 81 cents here to break even. It is not accounting for how much the option is worth. If this goes up to 268 or close to 268, and let's say in the next 30 minutes from when I buy it, this could be close to $1. And I just made 19 cents if you sold it there. You don't have to wait till it gets to 268.81 to think that you're going to break even. That's not how option pricing works. So options expire worthless. So if this stays out of the money, so let's say this goes 267 instead of going higher, it goes lower. I'm only going to just to break it up here. I'm only going to use calls, for example. Puts are the same exact thing, but the opposite. So when you buy a call, you're long the market. If you buy a put, you're short the market, ideally. So I'm just going to use calls, for example, because there's no sense in going back and forth. So let's say, for instance, this goes away from my strike price. The closer it gets to expiration, the faster this is going to get to zero. So if I click on this, let's just say there's something called here down called the Greeks, and then there's called theta. So theta is going to say, every day it's going to wear down 25 cents until expiration. So this call is only worth 81 cents. So if today it's going to be worn down 81 cents, tomorrow it's going to be down 81 cents if it stays the same price. However, the further it goes away, let's say this drops to 267. So it's at 267.51 now. It drops to 267. This could be worth only 40 cents because it's this close to expiration. So if you want to, if you want the option prices to swing not as much, you want to buy further out. So if you take a look at the theta here was negative 0.25, and let's go to further out. Let's click on the 30th here and see what that is. And you see the theta here is 0.09. And also keep in mind that the options now 239 instead of 81 cents. And the reason for that is because it has more of a probability of it to go up to be above 268 than it does on April 18th. So it has more of a probability to be above 268 on April 30th than it does on April 18th. That's why the option prices are more. So if you're concerned, like, hey, I think this is going to work out, but I think it's going to work out this month, you're not going to want to buy one for April 18th. You're going to want to buy one for April 30th. So you want to give yourself enough time. Obviously, you're going to be paying more premium for that time. However, the swings in the market are going to hurt you less. Now, if I bought this, the closest to the expiration, if I bought this, this drops, this option price is going to be cut in half. So when you're trading that close to expiration, it's almost like a penny stock. When you're trading that close, you really don't want to load up. You don't want to make like a $10,000 trade or a $5,000 trade. You just want to, buy one of these or two of these. Typically how I trade. So if I think that a lot of times I do trade on the day of expiration. So maybe on a Wednesday I'll trade this. If, depending on what it is, I'll buy a couple of these and I'll trade the daily chart. However, I don't always trade the daily chart. Sometimes I trade weekly. Sometimes I trade monthly. It really depends on your assumptions. So you need to get the timing right. Another thing that goes against you that I think that Robinhood doesn't do good at. So this is the option chain right here. It doesn't really show you like volume unless you click on it. Say I'll click on this 268 call again. You click on it, and then in here you can see the implied volatility, volume, and open interest. What I really like about other platforms, I'll pull this up here. This is TD Ameritrade Thinkorswim. Let's see, we're at 418, just so we're looking at the same thing. Okay. So just so you look at the one thing that I like about here is the calls are in one column and the puts are in another column, and then you can see the open interest and the volume. And with SPY you don't really have a problem, but you can see like the volume here is 27,000. So like I said, this is very, very high volume. However, what's interesting to me sometimes is seeing which one has the highest volume. So these 267 calls today had 27,000 volume, and then the next one had these 270 calls had the next highest volume, and then for some reason, people bought 400 out here for expiration. And for me, volume is telling because sometimes people know more than what you think they are. Maybe there's going to be political things, and you can actually, if you line volume up with political news or anything else that's coming out, it's definitely very telling. So I like that. And to give you a what that would look like on the mobile, let's actually go to here. Here's SPY, looking at the 18th. So this is how they do it on mobile, just so you can get a feel for how that looks. Oops. Here's that 268 call, and here's the calls and the puts, and that's how they line up. And then you can kind of scroll left to see what the volume is. On Robinhood, you don't really they simplified it. They made their own interface, but I think that it hurts the end user because you can't see the end volume, you can't see what implied volatility is, and you don't get enough information. So Robinhood for buying and selling options, I really think that it's for beginners getting a feel for what this is. You're not gonna, maybe you can, but I feel like you don't have the tools at your disposal to make you super successful. So that's why it hurts you there. But it gets you familiar with options. Now the other question I had was, what happens if my contract expires in the money? Now typically what happens, let's say this 268 call above is above 268 and I forget about it. What happens is that contract exercises, and when you exercise a contract, that means you have to buy 100 shares of that stock. So in this case, SPY, see the contract, it's 100 shares here. So I've had one. You're going to have, I'll do this little math here, 268 times 100. So I'm going to need $26,800 in my account on expiration to purchase these shares. And one thing that Robinhood does do for you is if you don't have the money in your account 1 hour before close, they automatically sell it for you. And the thing is, when they do that for you, you're not going to get the best price. Robinhood's looking out for themselves as a broker and to minimize risk. And if you're letting it ride that close to expiration and you're in the money, they're going to sell it for you. If you're in close to in the money, they're going to sell it for you at whatever price they can get. So it's always in your best interest, if you're trading that close to expiration in Robinhood and you don't have the money in your account and you let it go to 3 o'clock Eastern time or after, just be aware Robinhood will close that out for you. And you may make money, you may lose money, who knows. They'll do whatever they can do to get out of the trade because you don't have the $26,000 to back it. Now if you do, then they'll exercise it. You'll pay this price, but then you'll own 100 shares. You can either hold on to it for as long as you want, or sell it the next day, or whatever you want. The other thing is that people have been asking is, hey, I'm up 50%, I'm up 10%, I'm up 30%, I'm up 100%, and when the thing is about options is when you're right, it calculates. It goes up quickly. So you could be up 10% in 5 minutes. You could be up 50% in 5 minutes. You could be up 100% in 10 minutes. It really scales that way because you're using leverage because you're controlling 100 shares. So when there's a big move, you can take advantage of that with the options. However, you definitely don't want to get greedy. You don't want to get greedy in the sense that, hey, I'm up 100%. Should I wait till I get to 500% because I'm typically making 200%? Options you can easily make 30, 40, 50% easily and consistently. Look at all, if you held these options today, you were making 40 to 30%. But some days if we have big moves, these could be 500%, these could be 600%. And sometimes you do get lucky that momentum goes your way, and sometimes you make more and sometimes you lose more. But in this case, always take the profits. You're up 50%, take the profits. How many of your friends know that are making 50% on a trade consistently, or 20% on a trade consistently? And in options, we do that all the time. We make 20% to 50% all the time. And if you do that enough times, you're going to make a lot of money. Now, if you make 100% once and then you lose the next time, what good is that? So I always say, always take profits, protect the bag. There's people out there, when you have your money at risk, they want to take it. They don't want you to win. So I hope I covered some of the risks of trading options in Robinhood. Options is a great tool. Robinhood, their interface does a lot of things that maybe are counterintuitive and doesn't give you all the information up front. But if you get used to selling calls and puts on here, I think it'll be a great intro once you start trading on Thinkorswim or Tastyworks or any of the other E-Trade or some of the bigger brokers that give you more tools when you can sell spreads easier. On here, you can't sell spreads very easy. I mean, you can do it, but you got to buy the long leg first, and then you got to sell the short leg. It's not great in terms of that. So for now, I just say just buy calls, sell puts. Very simple. Keep your risk low. Don't spend a lot of money, because if you don't know what you're doing, you're most likely going to lose it. I just wanted to go over some of the basics and some of the risks that you have when trading Robinhood. Leave a comment below. Let me know if this was helpful for you in understanding some of the risks. and hopefully Robinhood improves and we can make another video on things that they did right or things that they did wrong, and just kind of build the community together. So leave a comment below. Definitely interested in how your trading is going.